We're going to leave equities for just a moment now and talk about the bond market. Jim Stening from FIIG Securities is with me here in the studio. Jim, thanks very much for your time.
Thanks, Carla.
Let's talk about the Commonwealth Bank pearls. They debuted on the market yesterday. How did that go?
Yeah, they did. It was a good result. The issue came on at around a 2.5% to 3% premium. So, as hybrids go, that's a very good debut, I suppose. It wasn't without a few hiccups along the way. Obviously, the listing was delayed 24 hours due to a technicality, and there were some question marks during the process about the tax treatment of the franked dividends. So, despite those issues, we've had a very well bid market on the open. Okay.
Will the success of this, I suppose, encourage other issuers to tap the retail market?
Yeah, look, I think it's an obvious source of these types of funds. I suppose it's contingent on the requirement of the large banks for this type of capital, but definitely it's a heads up, and it's certainly available to these institutions.
Obviously, there's a little bit of a quieter period, I suppose you could say, over summer. So if you're expecting to see any other offers from, the banks, I suppose, would that actually need to be in the next few weeks?
Yeah, look, I think so. I think we're going into December, things quieten down, and January is a holiday month, I suppose. So yeah, look, in order to get from go to woe in terms of a retail issue, you do need 4 to 6 weeks. So if there are some issues in the wings, I'd expect to start to see those over the next couple of weeks.
Let's move on and talk about the Aussie dollar. Slightly weaker at the moment, but I mean, geez, the US dollar's just been taking an absolute thumping.
It has.
Are Australian investors, how does this all sort of tie into the bond market? Are Australian investors buying overseas bonds now because of the higher Aussie dollar?
Well, I think that's a trend that's just starting to unfold. It's not something that Australians have really been comfortable with or done a lot of in the past. Generally speaking, our interest rate investments are domestic. Over recent weeks, we've actually seen some people repatriating funds, so selling foreign-denominated bonds. But yeah, look, I think that as we see the currency appreciate, and at the rate it's going, it won't be long before we have a one in front of it, sort of thing. I mean, well, that's certainly the talk. So we are seeing a lot of inquiry, particularly from high net worth, self-managed supers, those types of people looking for foreign currency denominated bonds.
So how attractive is the Australian bond market then to overseas investors at the moment?
Well, it's still proving to be very attractive. I mean, we've still got high nominal yields. The carry trade with our interest rates moving up out of step with lower rates around the world, I think there's a lot of demand for our types of assets. I mean, I think, this development that we talked about recently, the FSA giving the tick to the Australian government bonds as liquidity, qualifying as liquidity for UK banks, if that's a trend that emerges globally, it means there'll be a lot of demand for our bonds or Australian-denominated supranational bonds.
Okay. Let's talk about we sort of had Chris Bowen earlier this week flagging, I suppose, the possibility. I mean, it's a talk that's been around for a long time and it comes up every now and then, but talk about increasing the amount that we have to, as Australians, put away for our retirement into superannuation. Do you think it's a good idea?
Well, I mean, I suppose I don't think it's a bad idea. No, I think essentially the more money we have in retirement, the better, and being forced to save is a great way to go about it. I think one of the things about the the way this defined contribution scheme that we have in Australia, it means that Australians really do have more control over how they allocate their exposure, and predominantly the exposure is the equity box has been ticked. And so I think if we do increase the defined contribution, it makes sense that those contributions should be more weighted to lower risk assets to return the same amount on retirement. So
you would say that, though.
I would say that. That's right. But I do think that, I mean, it's interesting because, I mean, the OECD released a very interesting document about asset allocation in pension funds around the globe, and Australia is really the standout allocator to equity markets. You've got, say, the key European economies, allocating around 20 to 25% to equities, whereas in Australia we're almost scratching 60%. So I think it's definitely something that I suppose Jeremy Cooper will be looking at in his review of the superannuation, the whole of superannuation in this country.
I was going to say, so coming out of that, I mean, is it something that not perhaps in his ear about it, but does there need to be legislation or something brought in, do you think, to stop
Well, I mean, there's a number of ways it can be done, I suppose. If people don't select certain asset allocations, then they move to a default. Or I suppose it could be age-based type allocations or parameters or guidelines that are appropriate. But look, I think, definitely needs to be looked at. Obviously, equity markets are a higher risk allocation, and that can lead to higher volatility in terms of returns. And so, if you're retiring and you're at that unfortunate time where equity markets are in a severe downturn, that can be fairly disastrous. So, I would certainly recommend a focus on that asset allocation.
So not necessarily increasing it, but just looking at changing the asset allocation, whether or not we stay at where we are or not. You think? For safety's sake.
Certainly if it's increased, I think it becomes more important, most definitely. But if it's not increased, I think that the asset allocation issue is crucial. Does it
need better tax treatment to get people on board?
Well, I mean, again, it depends. I mean, again, I have to declare my bias in that I think that interest income-related investments need to be probably given a bit of a leg up in terms of tax. But yeah, no, I think that's something we'll see out of the Henry Review. There's a lot of these things coming to a head towards the end of this year, and it'll be very interesting. It'll drive product design, I suppose, in the next decade.
Let's just touch quickly again on the corporate credit market. We had Fitch ratings agency out overnight saying it expects the credit ratings for Europe and Asia of the big corporates to stabilise during the second and third quarters of 2010. Is that really a surprise? Or?
Well, I would hope it's stabilised by then. I mean, we've been through hell already, and arguably there's stabilisation is happening at the moment. We are still going to go through this period of defaults, and but yeah, look, I mean, that makes a lot of sense. I'd argue that it happened sooner than that.
Okay. And just one more question. Glenn Stevens speaking quite shortly in Perth at a breakfast do over there. What will you be looking for from what he's got to say in terms of rates, I suppose?
Well, I think a quarter point rise in November is more or less baked in the cake. I mean, personally, what I'm looking for is his comments really on what role monetary policy plays in a GFC type scenario. I think it's really interesting to look back and see, the steps that were taken through the GFC to ease monetary policy, and arguably if they weren't accompanied with aggressive stimulus from the government, they would have been completely ineffective, and when we probably have very zero rates here as well. And interestingly, I think very interested to see how he views the management coming out of the crisis and whether rates need to be as high as they were in the past.
Okay, so you're putting your Melbourne Cup money on a rate increase.
I am.
All right. Thanks for coming in. We'll see you again next week.
Okay, thanks.